I see a lot more for sale signs and sold signs than I've seen in a long time. But then I look on the internet and I see places like Phoenix and Florida, and housing is starting to soften a little bit. What are you seeing in housing, and what should we be thinking about, or what should we be looking for as investors?
Yeah, and it is a little bit. We've talked in the past about how a lot of homeowners are stuck in their mortgage. They've refinanced or bought at such a low rate that it doesn't make sense for them to sell when the next house they're going to move into, they're going to have to get a 7% mortgage.
Hmm.
And we talked about how eventually that'll start to give. At least 5% of the population needs to move a year just from death or divorce or whatever. And you can only put those things off for so long. And so what we're starting to see now is that even though mortgage rates have not come down, the need for people to move, is overcoming some of that. So we're getting a little bit of supply in the market, and that's not being met with added demand because the mortgage rates are still high. There's plenty of demographic support for more demand, but everybody's just waiting for lower rates. So that's put a little bit of pressure on housing, but I want to characterize that a little bit. I mean, it's basically we've gone from like core logic year over year. Last month was like 2.9% home price appreciation. So home price is going up, and then this month's like 2.5. And likewise with Case Shiller went from 3.8 to 3.4. So still housing home price growth, but it's definitely slowing down.
Hmm. Well, that's kind of interesting. I did read something that 25% of the new builds, they're not building, they're just sold lots or they're sold properties, but construction hasn't really started, as if people put a down payment and are assuming prices are going to come down or rates are going to come down before they finish that construction. And we all know the new homes are a part of the story, but it's really existing homes. That's the big supply. That's where things really need to move. What do you guys see historically from a interest rate perspective is kind of that number where this could loosen up a little bit and you'll start to see more things moving for those existing homes in terms of sells or moves and that sort of stuff?
Yeah, that's a good question, and it's a moving target. I would have said a year or two ago we would need to get back down to 5 or 6%. Like on the supply side, the demand has built up substantially. So even 50, 100 basis points starts to bring people into the market. We've also seen the shift. That renting used to be cheaper than buying, for many years, and now buying is cheaper than renting. At least in some areas,
Sure.
not broadly yet, but in some places we're starting to see that as well. So, I'd say any move down in interest rates gets some things moving. If we get two rate cuts in September, that'll get some things moving, assuming that mortgage rates drop as well. I think if you see 100 basis points, things can really get moving in housing.
Yeah, I want to ask one more question about that. There was this, I don't know if it was fearful mongering or what it was, but a couple of years ago, we heard a lot about BlackRock or big institutional investors coming in and buying up swaths of homes and gobbling up inventory. Lately, I've heard that they're starting to panic a little because that 3 to 5 year window where they need to roll it over for reinvesting or put that money to work, refinance their debt or whatever is coming to a close. What's been the take on that in terms of these private equity firms, these private people buying homes? Are they still buying? Are they selling yet? Or is that still a couple years off?
That's a good question. There was I guess a thesis out there for a long time post GFC that housing was going to become an institutional asset class,
Mm,
like everything else, like corporates, or the mortgage market itself, and that these large institutions were going to be the ones that managed all the housing. And initially they raised quite a bit of money, went out and bought a lot of homes. Um, that said, the U.S. housing market is the largest market period in the world. I mean, 35 plus trillion. It's a lot for even institutions to gobble up. There's American Homes, Invitation Homes are publicly traded, and they've been doing all right the last year or two. But they definitely slowed down. I'd say really since rates have been higher, last 3 or 4 years, they haven't been out in the market as aggressively.
Sure. Well, it seems to me, I joke with my dad all the time that in the 80s, his asset was his home, and that liability was the 18% mortgage payment. Whereas now, if I have a 3 or 4% mortgage payment, that is my asset, and my house is the big liability. The broken windows, the garage that needs done. That's a flipping on its end from people in their 60s and 70s versus millennials and below. It's a real new geographic and generational change that we've seen.
Well, interesting on that note, the demographic component isn't quite what people think, at least what my understanding what people think. You typically think of the first time home buyer, or I shouldn't say the first time home buyer, the buyer in the market being somebody that's in their late 20s, early 30s, recently married, been saving up, going to buy a house. You go back 30 plus years ago, I wish I had this statistic memorized, but the primary buyer in the market was born in like 1945. Today, the primary buyer in the market was born in 1945.
Holy cow.
It's the same group. They're buying their second house now. And so the younger generation hasn't really, experienced ownership yet. They're still living at home or, with roommates or renting.
That's crazy. And talk about more of the technical side of markets too. All of a sudden there's a big, beautiful bill that might pass. There's a lot of government spending going on. Gold is up, the dollar's down, rate cuts are being forecast here. And it seems that spreads are pretty tight. What are you seeing in the fixed income market right now? And then where is money going? We'll consider you our key to institutional spending.
Right.
Where is money going in these institutions or big places you've seen?
There's a change happening right now. Definitely. You may have heard a lot in the news about banks doing less lending, and private lending being kind of the source for a lot of lending. And I was actually watching an interesting interview from Russ Brownback at BlackRock, who basically said, well, he did say, securitized products are now the primary lender in all asset classes. And I haven't done the work on that myself, but I can believe it. So there's a lot of money in securitized products, a lot of money coming into securitized products, and that to answer your question, you compare that to corporate spreads, which is usually what people are kind of talking about. Spreads being really tight. Corporate spreads have been and are tight. We're finding, we bought a AAA the other day at 140 over. I mean, so there's definitely more spread in the securitized products space. And a lot of money is finding its way into that, particularly from the money managers, larger money managers. And it's really just the first or second inning of a
Hmm.
big move. There's a massive amount of cash to put to work here, at some point.
Well, I've still seen some data that shows we're talking 6, 7 trillion dollars in money market funds. If you watch the graph, it went up and it's pretty flat. Like it doesn't seem like more money is going in there, but it definitely doesn't seem like money's coming out of there. Is that what you guys are seeing as well?
All the conversations I've had the last 2 weeks have been with people who are rethinking that.
Mm,
That's definitely been the trade to put on barbell. You get cash on one side, and we got paid for cash. We got paid really well for cash,
mm,
and then tech stocks or Nvidia or whatever on the other side give you a ton of pop, and that's really been the trade. And as much as the bond guys like me were screaming, "Hey, yields look great. You should come over here." Nobody really cared as long as equities were cranking the way they were.
mm.
New highs in the S&P Friday, new highs today. Um, Almost all the conversations I've had have been with people who are going, Okay, I need to start rolling this in to some fixed income, because historically, especially like retail, will stay in cash, stay in cash, stay in cash, and then when they decide, okay, time to go to fixed income, the yields are at zero, and they can't get any yield.
Mhm.
And so the institutions are moving it over. A lot of the family offices and the smarter retail are thinking like, what can I lock in
Hmm.
fixed income? And a lot of that's been in the securitized products space. Well, like you mentioned, about 7-ish trillion in cash. The Barclays Ag, and basically the bond universe, throws off 1 to 2 trillion in payments a year. So that needs to be put to work, as well. I mean, there's potentially 9-ish trillion dollars
Wow.
to put to work, and it's in the early stages of moving, I believe, over, probably a little bit more bond focused than it has been.
So if securitized lending is the primary lender across all asset classes, that seems to me a lot less liquid than treasuries or the place where capital is stored today. These money market funds are super liquid. Is there some, I'm sure there's a premium on investments for the illiquidity, but that also means that not as much money is moving around. Does it? Or how does that impact liquidity considerations for investors, both big and small?
Yeah, I think that's fair. I think the mechanism for a lot of that has been, for better or worse, ETFs.
Oh, okay.
You can, I forget the percentage off the top of my head, but a large majority of high yield trades through the ETF.
Mm,
Um, and it's not like you can sell high yield bonds, that quickly or that easy, intraday, every, few seconds.
true.
And so it's a little bit of a mismatch. And I think, a lot of people have talked about the risk there, where people can get out of the ETF quickly. The underlying asset, maybe not so much. It's almost the opposite in securitized products, because there isn't that ETF. I mean, there's Barclays Ag, things like that, but as you mentioned, trades a little less frequently, and sometimes there's a little bit more work to do with it, and you pick up a little bit of spread. But also think about what that does to the stability of a market. It's not, you're not worried about J.P. Morgan going under because a particular asset class has gotten hammered.
Sure.
Um, these are owned by investors now, so it's not a levered bank who's got 5-10% capital to cover those loans. I mean, these are people that put up cash for the loans, and so I think it adds stability to the market. But fair point. Little bit more difficult to trade. But like with anything else, there's a life cycle to financial products, just like there is to other products. And it probably won't be long until we're seeing ETFs and other things to help
Yeah.
facilitate trades.
Well, we're getting these prognostications that these interest rates cuts are coming. Like it could be two this year, September, maybe. I saw a forecast that'll be three by June of 2026. If those rates were to come down, let's just say, let's give a couple examples. Say they come down a whole percent. What will that do for the fixed income market? How will it impact that market? Where do you think money would go if we had a large cut per se, 1%? Or we kept it in small cut 25? What's the difference and what should we be thinking about?
That's a great question. And each asset class kind of will behave differently.
Mhm.
Most bond managers will break down bonds into a couple of risk buckets. One being duration, which is just how much the price is going to move based on interest rate cuts.
Mhm.
So obviously longer bonds that have a lot of duration would benefit the most from a big cut. The other kind of component in bonds would be credit risk.
Mhm.
And so, that doesn't have as much to do with the interest rates themselves, although often, the kind of the tail is wagging the dog there. If there's risk in the corporate sector or risk to the economy or like a recession coming, obviously that's bad for credit. that also usually leads to a scenario where rates are going lower. And so you get a little bit of a trade-off there. I think in the scenarios that are probably placed before us, I think most of the consensus is, not a lot of risk of rates going higher from here.
Mhm.
The question is kind of, do they go lower, and how much lower, and when?
Mhm.
And so, I see people, putting on duration, kind of as we were talking, moving over to the bond market, locking in some longer term yield. Um, most people, I don't think, are going out, beyond about 10 years. It seems to be kind of the intermediate spot, seems to be the sweet spot. And then credit really varies. I'm a bit biased being a securitized product fund manager. I think, I'm seeing some of the best yields, best opportunities we've seen in almost 10 years,
Mhm.
in this part of the market. Certainly, some others are maybe in the seventh inning or something like that of a tightening. But I think that I see a little bit more opportunity in securitized products. I'm definitely seeing money managers looking more into this space.
Commercial versus residential. I mean, CMBS stuff has been the wicked stepsister stay away for a while, but we all knew that eventually stuff was going to get so beat up that it was going to be something really interesting. Are we closer? Are we the same as we were a couple of years ago? Is it getting more interesting? What's your thought on the dynamic between commercial and residential in terms of a package or mortgage-backed product?
Yeah, it commercial is really interesting because it has been historically has been able to weather so much more. And even, the office debacle kind of right now, where, the office space has just been, obliterated, and occupancy rates are really low. And we're well into that now. COVID, we're 5, 6 years ago. And so far, CMBS has been able to kind of refinance or move things out. Certainly spreads blew out pretty wide. They've come back a little bit, there's more pain to be felt, but it's hasn't been mass hysteria or defaults yet. A lot of that's because those buildings haven't traded. At some point, they're going to get marked to market, and then the bonds are going to realize that they're trading at 40 cents on the dollar, or whatever that number ends up being. There's also talk about being able to transition, say an office building into residential, multifamily kind of situation, and the first two people that tried that found that that's not really feasible. You're talking about plumbing to every unit on the floor rather than one bathroom on the floor. It's a pretty big overhaul. And so far it's just been kind of being absorbed. I guess kind of to summarize what I think is going on in commercial, it's really nuanced. Definitely not for the faint of heart, but there's a lot of opportunity there now. Prices have moved a lot. Spreads blew out. They've come back in a little bit. But there's definitely nuances. If you have a manager that has, we say, boots on the ground, they're in the building, so they know what the tenants are doing. There's certain bonds within securitized product structures that have the rights to refinance or to work out debt, and they hold a lot of leverage. And so there's a lot of nuance. You really want a specialty manager to participate in commercial right now, but there's probably a lot of opportunity. Residential is a much more stable story. It's particularly in the season space. Now you're talking about homeowners that have made it through a crazy stress test of the great, GFC, and then they hung on to their mortgage through a period of basically zero interest rates. And so these are borrowers that just aren't going to do anything. They're just going to pay their bill, and that's it. And so it's a
And Garrett, real sorry to interrupt. How do we define seasoned? Is there is it a specific term or just a general term?
It's kind of a general term, and but I'm glad you made me define it. I'm definitely thinking, 2005, six, and
Okay.
seven. But
Pre GFC is okay.
GFC, that's right. But even seasoned, going back 3 or 4 years, they built up quite a bit of home equity at this point,
Hmm.
and have, are their, as you mentioned, their mortgage is an asset now.
Hmm.
They do not want to default on their house and have to, buy another house, across the street at 7% mortgage rate. So they're very motivated to make sure that they make their payments. And so Resi right now is a much more stable profile than
Gotcha.
commercial, but if you know what you're doing, there's some opportunity in commercial.
Well, I want to ask another question about that residential. Are there between non-agency and agency at this time, are we seeing a big difference in terms of the spreads, the opportunities, the potential yield on investing there? I mean, obviously you have a bias to season, but let's ignore that and think of more recent non-agency versus agency. Is there a preference you're seeing or where money's seeing a preference?
Yeah, actually we own both. So
Hmm.
I like both here. And just in case people don't know, I mean, agency mortgages are guaranteed by the U.S. government, and so there's no credit risk, and you're comparing them to treasuries, where you,
Okay.
you get a risk-free rate and a locked-in payment, and but what we call speeds, whether people refinance or not is the concern. And typically with mortgages, you make meaning more yield on them, or at least it'll initially model out that way, because you get hurt either way. If interest rates, let's say you lock into a 6%, Fannie Mae bond, you're getting your 6% interest. The prevailing mortgage rate is 6%. I'm just making this up, and rates go to 7. Now the market is at 7, but you're only getting paid 6. And
Hmm.
so your bond went down, and let's say the average cash flows you're coming up with are 10 years, just to make it easy. Um, you Nobody is going to refinance from a 6 into a 7. So you get like very low speeds, and so your bond actually becomes longer because nobody refinances. So your duration's longer, so you get hit harder with that 1% move higher. On the other way, if rates, usually bonds do well when rates go down. So let's say we go from 6 to 5% mortgage environment. You're high-fiving yourself. You're like, I bought at 6. Now everybody else is stuck with 5, and your bond goes up in value, which it will, but it won't go up as much as, say like a treasury that had the same sort of duration, because everybody refinances. They're like, hey, I can refinance at 5. I'm out of here. And so your bond really shortens, and you don't move with that full 10%. You move with like 5. So because of that, we call it negative convexity. Mortgages tend to pay a little bit more. And in this environment, that they've been paying quite well. And so we like them, just what's called the basis spread. But I think if I had to pick, I certainly would pick non-agency, because of the credit component there. You're getting paid so much for an asset class that I would argue is a better credit than the corporate space right now, just because of what housing has done the last 10 years. Whether it's 2 years seasoned or 15, I think it's a pretty good asset class.